at 10 a.m. ET on Friday. The old playbook tried to smash silver under $65, and it failed. By Saturday morning, the real shock wasn't the price at $67. 14? It was the silence. Dealers stopped selling. I've watched enough Friday tape to recognize the intent without needing a press release. The sell pressure always arrives with the same posture fast. Heavy. Designed to make the weak feel like a trap. This time, the market didn't flinch. The settlement print at 4p, M, wasn't just green. It was defiant. And that matters because a settlement price isn't a vibe. It's a line in the ledger. It's what risk departments use to decide who gets margin calls, who gets credit tightened, and who spends the weekend praying for a Sunday night rug pull. But the chart wasn't what woke me up on Saturday. The chart is theater. The supply chain is the plot. I started where the truth always leaks first, the checkout buttons. Dealer sites that had been normal all week were suddenly careful. Some had maintenance banners that felt less like web work and more like triage. Others showed products that were technically available but priced so far above spot that you could hear the subtext through the screen. Don't make me sell this to you right now. A few didn't bother with subtlety at all, sold out flags everywhere. Like someone pulled inventory behind the curtain. So I did what I always do when the narrative and the evidence diverge. I built a simple field, metric, nothing fancy, just honest. I checked a broad slice of retail channels and wholesalers and counted how many were functioning normally versus frozen, capped, or refusing to quote. It wasn't perfect, but it didn't need to be. When the dealer freeze index prints above 60% in less than a day, you're no longer looking at high demand. You're looking at an availability event. By noon, it was sitting around 62-68% depending on the cut. That's not enthusiasm. That's retreat. Then the emails and messages started landing. Not from the loudest people on social media, but from the ones who actually have to ship metal. North Star Bullion didn't sound excited. Their operator sounded like a person trying to keep a business alive through a market that just changed shape. He didn't talk about charts. He talked about replacement cost risk because that's the killer that doesn't show up in a candle. If you sell 10,000 ounces on Friday at a price you can't replace on Monday without losing your working capital, every sale becomes a slow-motion liquidation of your own solvency. And dealers know something retail often forgets. The moment a market turns vertical, inventory stops being stock and starts being a liability if you can't replenish it. I asked a simple question. Why not just sell at spot plus the normal premium and restock next week? He didn't laugh. He didn't need to. He just explained it the way merchants explain gravity. Spot said $67. 14. Physical replacement wasn't $67. Physical replacement was a moving target, $78. $82. $85. If you could even get a firm quote. And if you can't restock, you can't price. If you can't price, you freeze. It's not a conspiracy. It's a survival reflex. That's when Metro Metals Wholesale entered the story, and the story stopped feeling like retail noise. Wholesalers don't get dramatic. They get restrictive. Their language is the language of rationing, allocation, caps, lead times, and the quiet phrase that ends arguments subject to availability. The notice was blunt enough to feel like a confession. Max 50 ounces per order, 14 21-day lead time. Those aren't marketing words. Those are the words of a pipeline that can't satisfy demand at the current pace. When a dealer tells you sold out, that can be theater. When a wholesaler caps orders and stretches delivery windows, that's infrastructure talking. I could feel the emotional arc in real time. The stackers I know weren't confused by the premiums. They were validated by them. The tourists' late money, screen-driven, kept asking why the real price on their phone didn't match what the world was charging for deliverable product. That question is the entire conflict in one sentence. The price you can track is not always the price you can transact. Premiums in a normal market are a service charge. Premiums in a stressed market become a rationing mechanism. They're the only socially acceptable way to say, we don't have enough to meet demand, so we're going to slow you down with pain. And the more the screen price rises, the more that pain has to rise too. Because the incentive to buy doesn't diminish, it multiplies. FOMO isn't a meme in moments like this. It's a force. This is where I use a word that makes people roll their eyes until it doesn't. Unobtainium. Not because silver is fictional, but because deliverable supply can become functionally imaginary when every node in the chain shifts from selling to conserving. The market doesn't have to run out completely to behave like it ran out. It only needs to hit the threshold where sellers believe restocking is riskier than refusing demand. And once that threshold is crossed, the system starts revealing what it truly values. Paper markets can print liquidity. They can print contracts. They can print exposure. What they can't print is metal that must be refined, shipped, insured, warehoused, and delivered on schedule. When physical stops flowing smoothly, everything else becomes a story told to keep the room calm. By the end of Saturday, I wasn't staring at the chart anymore. I was staring at the behavior. The market didn't just rally, it changed character. The refusal to sell at the retail edge isn't a side effect, it's a signal. It tells you that the people closest to inventory believe the next replenishment cycle won't be priced like the last one. And if that's true, then the real question isn't whether the price can be pushed around for an hour on Globex. The real question is what happens when a market that's been treated like a paper casino starts behaving like a physical commodity again, heavy, finite, and unforgiving. If retail shelves are empty and wholesalers are rationing, then the obvious question isn't why is price up? It's who is absorbing supply upstream before the public market even gets a chance. The headlines call this speculative froth. My browser shows sold-out banners and no-quote screens. When media comfort collides with supply chain refusal, I always trust the side that has to ship metal. On Sunday, December 21, 2025, the official story was soothing, a sharp rally, a little excitement. Nothing structurally wrong. The talking heads kept repeating the same frame, too much leverage, too many Reddit traders, a crowded trade that would cool off once the week reopened. It's a familiar script, and it's designed to do one thing, keep you watching price instead of watching behavior. So I stopped listening and started collecting exhibits. At 11:18 a.m. Eastern, a wholesaler contact forwarded me a one-page update from Metrometals Wholesale. No drama, no sales pitch, just operational language that reads like a fire door swinging shut, allocation only. The memo didn't say sold out. It said, in corporate shorthand, that normal flow had been suspended until further notice. 10 minutes later, another screenshot arrived from a different desk. A pricing portal that usually refreshed in real time now displayed a blunt placeholder, no, quote, call desk. This is the moment the silver market splits in two. Layer 1 is what the public sees, futures prints, ETF ticks, spot quotes that imply you can always transact if you accept the price. Layer 2 is what actually moves atoms, bars with serial numbers, refinery schedules, insured transport, and inventory that has to exist in a specific place at a specific time. Paper can change hands 1,000 times without anyone lifting anything heavier than a phone. Physical doesn't get that luxury. And when physical gets tight, the first panic you see isn't retail FOMO. It's custody anxiety. By mid-afternoon, the London tone had shifted. I'm not talking about a press conference. I mean the quiet operational requests that never show up on TV. A family office ops lead doesn't ask, "Do you like silver here?" They ask, "Can you allocate it?" They want names on bars, segregated shelves, and, this is the tell serial numbers, unallocated balances are comfortable in calm markets because everyone assumes the pool is deep and fungible. In a stress market, unallocated becomes a question mark, a claim that only matters if it can be converted into specific bars when asked. One clearing contact put it as plainly as he could without putting his job at risk. Allocation conversions were running at roughly 3 times a normal weekend rate, Not because everyone suddenly became a prepper. Because wealthy people understand something most screen traders don't. Confidence is a physical phenomenon. It lives or dies on delivery. Now zoom out and watch where the metal wants to go. When Asia wakes up and the Shanghai premium starts speaking louder than New York, the arbitrage becomes irresistible. If one venue is willing to pay more for immediate, deliverable supply, metal migrates. Refiners don't pledge allegiance to a headline. They ship toward the strongest bid and the cleanest payment. That flow doesn't need a government order or a secret meeting. It needs a spread wide enough to pull inventory through the pipes. And it's not just exchanges pulling on that pipe. It's procurement. A lot of people assume big industries hedge like traders buy some futures. Roll them, call it a day. That works when the system is liquid and delivery is a formality. When supply tightens, futures become a nice to have, and procurement becomes existential. You can't build next generation hardware on a paper promise. You need molecules in the right building on the right date, with penalties attached if you miss the schedule. That's where the real twist comes in. And it's why the dealer freeze matters more than any candle. What I'm calling Project Silverlock isn't a rumor about a single mystery buyer. It's a procurement posture. Strategic buyers, tech, and industrial names with huge throughput are stepping around the public market and locking supply upstream. The structure is simple and brutal. 18 to 24 months of offtake, mine gate pickup, refinery priority slots, and payment terms designed to win in a shortage. That metal doesn't circulate into the usual wholesale pools. It never becomes available inventory for the public at any price that resembles spot. So when the media tells you this is froth, ask yourself a better question. If nothing is wrong, why did professionals stop quoting? If Silverlock is draining supply upstream and the public only sees the leftovers, the next fight isn't retail. It's the paper market's math. And the first numbers that matter are sitting right ahead, $70 and $75. People think markets move on news. Banks know markets move on deadlines. And the first hard deadline hits at 8 a.m. ET Monday, when variation margin is due and excuses don't clear. Sunday night is where the week is decided before the week officially begins. At 6 p.m. at Globex opens, and the first prints come through in thin, liquidity-wide spreads. Jumpy quotes, the kind of tape where a few hundred contracts can create the illusion of certainty. Retail sees a number and calls it the market. A bank sees a fragile bridge between Friday's settlement and Monday's margin clock. I keep two screens up at all times in moments like this: price and obligation. Price tells you what people want. Obligation tells you what they must do. Variation margin is simple when you say it out loud, and vicious when you live inside it. Every day, the exchange recalculates gains and losses. Winners get paid. Losers wire cash. For small traders, it's automated and fast. For institutions, it's relationship-driven until it isn't. Prime brokers extend credit lines. Risk desks tolerate drawdowns. Calls are made behind closed doors. But the tolerance ends when the math breaks the credit limit. That's why Monday 8 a.m. matters more than any pundit. It's not the market's opening bell. It's the bank's alarm clock. I got the first tone change message before midnight. It wasn't a meme or a chart. It was a short note from someone who speaks in deadlines. If they're short size into Monday, they'll be buyers no matter what. No ideology. No narrative. Just the cold truth of forced liquidation. If a fund is short and underwater beyond its cash on hand, the broker doesn't debate the thesis. It closes the risk. And closing a short means buying sometimes into a gap, sometimes into a vacuum, always with urgency that looks like insanity from the outside. This is how price moves on news without the news being the cause. The cause is a margin calendar and a risk policy. Now add the second engine, options. Most people treat $70 and $75 like psychological milestones. On a dealer's sheet, they're mechanical switches. When a market approaches crowded strikes, hedging flows stop being passive and start being reflexive. Dealers who sold calls hedge by buying as price rises. The higher it goes, the more they buy. That's the skeleton of a gamma squeeze, an acceleration that can look like pure emotion, but is really risk management chasing a moving target. The dangerous part is that it works both ways. A violent pop can force hedging buys into strength, and a sharp dip can trigger the opposite behavior. That's why I don't romanticize the move. I respect it. A market walking towards $70 and $75 with thin liquidity and stress shorts isn't a party. It's a minefield. The third engine is quieter. And in my experience, it's the most honest. Term structure. When I see backwardation in a metal like this, front month priced above the further months, I don't treat it as trivia. I treat it as urgency made visible. Roughly plus 0. 9% from the front to the 3-month isn't normal carry. It's a premium for immediacy. The market is paying extra for now because later is less credible. That's how shortages talk when nobody is willing to say the word shortage on camera. Backwardation isn't a headline. It's a confession. By the time Globex had been open a couple of hours, the discussion had shifted from how high can it go to how much has to be bought and by whom. That's the only framing that matters when obligations collide. You can't bargain with variation margin. You can't negotiate with gamma. You can't talk your way out of a term structure that's screaming for immediate metal. Then I do what I always do when the room gets loud. I go to the inventory classifications, because that's where the paper story meets the physical constraint. COMEX registered is not a philosophical category. It's the subset that is explicitly available to settle. Eligible might be metal in the building, but it isn't necessarily metal for you. Registered is the deliverable pool the system leans on when claims start acting like claims. The registered print I'm anchoring to is about 29. 4 million ounces. Down roughly 3. 8 million in 5 sessions. That's not a long-term trend. That's a short, sharp draw. On its own, it would be notable, but it doesn't exist on its own. It exists under a mountain of paper exposure. If you take open interest and translate it into an ounce equivalent proxy, call it about 1. 1 billion ounces for the sake of the stress test. The ratio becomes the story, something like 37 paper claims for every ounce of registered metal. People argue about the exact numerator. Fine. Argue later. The point is the same. This structure is stable only if most participants never request delivery at the same time. And that assumption is exactly what the weekend behavior undermines. When allocation conversions spike, when wholesalers stop quoting, when immediate delivery commands a premium in the curve, you're watching a system built on most people won't ask begin to face more people asking. Not everyone needs to demand metal for the math to change. The system only needs a marginal shift in behavior, a small percentage deciding they want certainty instead of exposure, and suddenly 37-to-1 stops being an academic ratio and starts being a countdown. This is where the bank perspective becomes a nightmare. A short position isn't a view. It's a promise to deliver later. If the price rises, the promise gets expensive. If delivery demand rises, the promise becomes harder to fulfill even if you're willing to pay. And when both happen together, price pressure plus delivery pressure shorts aren't just losing money. They're losing optionality. They can't choose a calm exit if the market opens into a gap and their margin call clock is ticking. I don't need to predict the exact open to know what the first hour will feel like. It will feel like urgency trying to disguise itself as liquidity. It will feel like bids that don't care about finesse. It will feel like the system discovering in real time whether it can still convert paper confidence into physical performance. And when you hear people say, it's just futures, remember what futures are built on: settlement. The moment settlement credibility wobbles, everything else becomes decoration. When margin pressure meets thin deliverable inventory, the market doesn't negotiate, it regulates. And I'm already seeing the first sterile phrases that usually appear right before the exchange reaches for an emergency protocol. By Monday afternoon, the market isn't asking how high can silver go. It's asking a more dangerous question: who still has metal to deliver and who only has exposure? You can feel that shift before you can prove it with a chart. The phone calls stop being celebratory and start being practical. People aren't asking me where the next resistance line is. They're asking me where they can actually buy. They're asking what counts as in stock. They're asking whether a confirmation email means anything if the seller can't restock without bleeding out. I pulled up the retail pages again, not to gawk at sold-out banners, but to track what the merchants were doing to protect themselves. The language had evolved overnight. On Saturday, it was cautious. By Monday, it was managerial. Quantity caps were no longer a temporary throttle. They were policy. Max, 50 ounces, PER, order, wasn't a suggestion. It was an attempt to ration demand across a shrinking pipe. 14-21-day lead time wasn't a shipping estimate. It was a warning that the pipeline couldn't keep up with the screen. North Star Bullion didn't want to talk about price anymore. They wanted to talk about liability. When I asked if they'd reopen orders if spot stabilized, the answer wasn't yes or no. It was a sigh and a conditional. If my wholesaler gives me a firm replacement quote, that's the phrase that defines a stressed physical market replacement quote. Not spot. Not fair value. Replacement. Because if you can't replace inventory, selling is a slow way of dissolving your own capital base. In a normal week, premiums are a nuisance. In this week, premiums were becoming a traffic control system. I watched the same products reappear briefly at prices that felt deliberately painful high enough to discourage impulse buying, not high enough to look like price gouging. It was a classic rationing move. Raise the cost of certainty to slow the line without admitting the warehouse is thin. Then the paper layer started to creak. SIVRX, my placeholder for the kind of silver trust people treat like a shortcut, was doing what it's supposed to do on the surface. It tracked. It moved. It gave everyone a clean, liquid number to stare at. And that's exactly why it becomes dangerous when physical tightness turns into operational friction. The promise of an ETF isn't that you'll hold a bar in your hand. The promise is that the products plumbing, create, and redeem will keep the price aligned with the underlying metal. That plumbing assumes metal is available at a reasonable spread to spot. On Monday afternoon, that assumption was the first thing to break. I got a call from a liquidity provider who usually speaks like a machine. He didn't sound panicked. He sounded annoyed because annoyance is what professionals feel when a mechanism that always works suddenly doesn't. He described it without drama. I can make the market. I can hedge the exposure. What I can't do is source size at spot-adjacent levels when the physical asks are way out and nobody wants to quote firm delivery. That's the quiet difference between exposure and ownership. Exposure is a number you can hedge. Ownership is an object you must locate. I asked him how that shows up in the real world for SIVRX. He chose his words carefully. In calm conditions, authorized participants can create or redeem shares to tighten spreads. But when the metal can't be sourced cleanly, or can only be sourced by paying up and waiting creation, redemption stops being a smooth arbitrage and becomes a logistical negotiation. And the moment it becomes a negotiation, the ETF stops functioning like a tight proxy and starts functioning like a tracking device with friction. A retail investor might never redeem an ETF. Most won't. But the crowd doesn't need to redeem for the system to wobble. All it takes is a new behavior. People realizing that in a shortage, the paper product can track the story without guaranteeing the outcome. They start looking at that ticker and asking the forbidden question. If I needed the metal, could the system produce it? Once that question spreads, the comfort that used to live in liquidity evaporates. While everyone argued online about whether this was real or speculative, my attention shifted upstream because shortages are rarely born at the dealer counter. They're born at the feedstock level, where schedules slip and priorities get rewritten. Late Monday, I heard the phrase that always makes refinery people go quiet. Transport restriction. Sierra Plata Complex, my Mexico choke point, wasn't out of ore. That's not how real bottlenecks usually present. The constraint was administrative and security driven, a permit review, a crackdown on concentrate movements, tighter controls on shipments. The practical result was boring and devastating. Delays. 10 to 14 days of feedstock disruption doesn't sound like the end of the world until you realize how thin the just-in-time supply chain has become when demand spikes and buyers start preempting future production. Refiners don't stop running because of headlines. They stop running because the feed isn't on the dock. And when feed is delayed, refineries triage. Priority slots go to the buyers who lock terms early, who pay reliably, who can take bulk, who don't flinch at price. That's where Silverlock matters without needing to be mentioned in every sentence. If strategic procurement has already reserved future flow, then any temporary delay doesn't get distributed equally. It concentrates pain onto the open market, the part of the system that lives on whatever is left. Dealers feel it first because they live downstream. ETFs feel it next because their alignment depends on availability. And by the time the public notices, the shortage has already moved through the pipes like a silent weather front. You could see the psychology turning from excitement into accusation. The late buyers blamed dealers for gouging. The dealers blamed wholesalers for rationing. The wholesalers blamed the market for moving too fast to quote safely. Everyone blamed someone, but the truth didn't need a villain to be true. When replacement is uncertain, selling becomes risky. When delivery is uncertain, paper becomes suspect. When supply is delayed, the system stops pretending it can serve everyone at once. I wrote down the Monday afternoon reality in a single sentence and kept it in front of me. The screen price is a reference rate. The deliverable price is a negotiation. In a tightening market, the negotiation gets louder and the reference rate becomes less relevant. Not because anyone conspired to change it, but because the physical world refuses to scale at the speed of paper. That's why this chapter isn't about where price goes. It's about where credibility goes. Credibility migrates toward the parts of the market that can settle, ship, and name a bar, not the parts that can print a number and call it exposure. When paper holders can't turn exposure into delivery, they do the one thing the exchange can't tolerate in bulk. They start demanding settlement certainty. And the moment that happens, the rulebook comes off the shelf. Markets don't collapse with explosions, they collapse with policy language. The endgame begins the moment the exchange prepares to replace metal with cash, while calling it protection. Late Monday, the tone of the market changed from competitive to procedural. Price can be fought over, procedure cannot. Procedure is where institutions go when they want to stop debating reality and start managing fallout. You could hear it in the way people spoke. Nobody was asking what silver should be worth. They were asking what they were allowed to do, what they were required to do, and what would happen if they didn't. The first signal wasn't a headline. It was a bulletin. It hit my inbox like a cold breath from the clearinghouse. An intraday margin adjustment, up 18% for the contracts that were suddenly experiencing extraordinary volatility. That phrase is always dressed up as risk management, but it has a second function everyone on a desk understands. It throttles participation. It forces weak hands to reduce exposure, and it buys the system time to see whether the next sentence of the story is organic, buying, forced buying, or something worse, a run on settlement. I called a prime risk contact I trust for one thing, honesty without theater. He didn't give me a prediction. He gave me a deadline. Variation margin is a clock, he said. If the wire isn't there, we don't negotiate the narrative. We reduce the risk. That's how markets get their violent moves, not from passion, but from policy. A fund can believe in a pullback with religious conviction. None of that matters when the broker's internal rules say the position is too large, too leveraged, too underwater. Now add the part retail rarely sees, the options wall. An options market maker, one of the quiet craftsmen behind liquidity, told me the truth in one line. Above certain strikes, hedging stops being an overlay and becomes the driver. When price pushes into a zone where call exposure is concentrated, hedges cascade. Dealers who sold calls buy futures to stay neutral. That buying lifts price. Higher price forces more hedging. The loop tightens. It's not magic. It's math with a feedback amplifier. And here's where the story flips. Exactly the way the public never expects it to. For decades, the smart money treated silver like a controllable market, a place where paper supply could smother any rally. That posture created a habit. Large commercial shorts sitting comfortably on promises of future delivery, assuming they could always buy time. But when physical availability tightens and the curve starts paying extra for immediacy, time becomes expensive. The shorts don't just lose money, they lose options. By Tuesday morning, what had looked like a rally started behaving like a trap closing behind the people who thought they were running it. Short covering wasn't a choice, it was an event. You could see it in the urgency of bids that didn't fade. You could hear it in the language of desks that stopped saying if and started saying when. This is the short squeeze, not as a slogan, but as a mechanical reality. A short covering cascade colliding with a gamma feedback loop. That's the moment settlement becomes the only question that matters. I pulled up the inventory classifications again because that's where paper confidence goes to be tested. Everyone likes to cite eligible metal when they want to calm the room bars in the building, metal that exists somewhere behind the curtain. But eligibility isn't obligation. Eligible is permission for an owner to register, not a promise to deliver. Registered is the pool explicitly tagged for settlement. When a market gets stressed, the difference between those two words stops being technical and starts being existential, and the institutions know it. That's why the language in the bulletins gets carefully sanitized. It doesn't say, "We don't have enough." It says things like delivery integrity, orderly markets, and temporary measures. The words are soft, the implications are hard. Somewhere between those bulletins and the desk chatter is the fork in the road I've been waiting for. Path A is brutal but honest. The market reprices to a level that brings out real sellers and discourages marginal demand. That's what price discovery looks like when supply is tight. Path B is bureaucratic. The system changes the rules of the game so it can survive without letting price do its job. That's where you see extraordinary provisions, discretionary settlement language, and quietly Rule 4, 7b, moving from a dusty reference to an active instrument. The public will be told it's for their protection. The truth is simpler. Cash settlement is the pressure release valve for a paper system when physical settlement becomes too expensive or too uncertain. It turns an obligation to deliver metal into an obligation to deliver currency. That swap sounds benign until you remember why people came here in the first place, because they don't trust promises denominated in paper. I watched the conversation shift among investors who thought they were being prudent by owning silver through proxies. The question they asked was the same one wealthy allocators always ask, just phrased with more frustration. If I can't get the thing, what do I actually own? That question is contagious. It spreads faster than any rumor because it's grounded in a basic human instinct certainty. And certainty is exactly what the rulebook is designed to ration. If Rule 4, 7b is invoked, paper holders won't get the asset they thought they owned, they'll get a check. And the moment the market learns that, the only question left is, what does physical silver cost when it's treated like infrastructure? In a real shortage, the winners aren't the loudest bulls. They're the quiet people who understood one rule early: possession beats promises. After a week like this, the temptation is to keep staring at the screen as if a number can soothe you. But the screen is where the system tries to keep you reactive, chasing gaps, second-guessing yourself, confusing motion for meaning. My job, and the only reason I write any of this, is to help you separate what moves fast from what matters. Because in the aftermath of a delivery shock, the real battlefield shifts from price to behavior. I've been asked the same question in a dozen forms since late December. What do I do now? People want to trade. They want a signal that removes uncertainty. I don't sell certainty. I point you to the places where certainty either exists or doesn't. And in this market, certainty lives in 5 things you can observe without trusting anyone's narrative. First, the availability. Not the spot, quote, availability. If the dealer freeze index stays elevated, if websites keep posting call for pricing, if order caps remain in place, you're not watching a normal market. You're watching rationing. When sellers control the flow with caps and lead times, that isn't temporary retail chaos. That's a supply chain protecting itself from replacement cost risk. Second, lead times. A healthy market shortens lead times as supply responds. A stressed market extends them. If 14, 21-day windows persist, it means the pipeline isn't catching up. It means wholesalers can't commit confidently. It means the people closest to metal don't believe replenishment will normalize on your schedule. Third, the curve. Backwardation isn't just a technical word you throw around for credibility. It's the market paying extra for immediacy. If the front remains elevated relative to the near future, if now carries a premium, you're looking at a shortage that is present tense, not theoretical. It's a timestamp stamped into the structure. Fourth, deliverable inventory, the registered pool, not the comforting eligible total. In calm times, people treat those categories like trivia. In stress times, registered is where settlement lives or dies. If registered stays thin while demand pressure persists, the system's margin for error shrinks. When margin for error shrinks, institutions reach for procedure, not price discovery. Fifth, paper friction. If easy exposure products remain easy only in the sense that you can trade the ticker, but hard in the sense that the plumbing can't cleanly source the underlying, then you're living in a 2-tier market. In a 2-tier market, you have to decide which tier you're actually participating in. Many people didn't realize they were making that choice until the week forced it. Now let's talk about the traps, because this is where most investors get hurt. Not because they were wrong about the thesis, but because they were forced out by the mechanics. Over-leverage is the first trap. If you need the market to behave politely to survive, you don't own a position, you're renting it from your broker. In a market that can gap on Globex and reprice on deadlines, leverage turns every wiggle into a threat. A rug pull doesn't have to change the trend to end you. It only has to hit your margin. Gap chasing is the second trap. The brain treats a fast move as a closing door. That's why people buy the worst prices. They're trying to buy relief from the fear of missing out. But markets don't reward emotional timing. They punish it. The right response to a gap isn't panic buying. It's discipline. It's letting the tape prove support, letting the market come to you instead of you chasing it into a volatility blender. Confusing exposure with ownership is the third trap. There is nothing inherently evil about paper instruments. The danger is assuming they grant you the rights you didn't actually pay for. If your position can be changed by a bulletin, if settlement can shift from metal to cash, then you are holding a contract with conditions whether you admit it or not. That doesn't make it useless. It just makes it different. And once you understand that difference, you can build your strategy around what you actually control. My strategy is boring on purpose. I watch the 5 signals, I avoid the 3 traps, I refuse to let a screen dictate my convictions. When the market is trying to throw people off the ride with volatility, I treat that volatility as a filter. It's not there to inform you, it's there to test you. That's why physical ownership has a psychological advantage that rarely gets discussed in polite finance. It can't be margin called. It can't be reinterpreted by a clearing memo. It doesn't require a redemption mechanism to stay real. It sits quietly and ignores the noise until the noise runs out of credibility. And the final point, the one that makes this whole story cohere, is that the premium is the truth. If spot is one number but deliverable product demands $11 to $18 more and still comes with caps and delays, then repricing has already started. You're just watching it happen through 2 different mirrors. This isn't a one-week event. It's a transfer from people holding claims to people holding assets. And once that transfer becomes obvious, the market doesn't trend, it revalues. If you don't hold it, you don't own it. I look back at the wreckage of the week, screens flickering, headlines spinning, and then I look at the weight in my hand, and the silence tells me everything I need to know. They mocked me for trading paper comfort for metal reality. But when the system started rationing trust and rewriting rules, the only thing that held its shape was what could be held. In a world of paper promises, only metal is the truth, and the difference between exposure and ownership is the difference between panic and peace. So hold what's real, share what's true, and remember this. We didn't escape with a number on a screen. We walked out carrying a key that fits no lock but our own freedom.